you very much, Don, for the introduction. Good afternoon, good morning for some. My name is Neil Kellock. I am a regional sales director here at Sun Life. Very pleased to be joining the session today. I have the good fortune of introducing my esteemed colleague, Frank Lapierre. Frank is an accomplished insurance professional, has got over 20 years of experience in the insurance business, including some time at some of our IROC friends, including an estate insurance advisor with one of the 5 big banks. Frank's extensive knowledge in both the industry and products with the largest insurers is an asset to our team here at Sun. In his current role, Frank is a life insurance product manager. He provides knowledge on life products to advisors and internal partners, such as our partners at IDC. Delivering presentations to convey our competitive positioning at Sun, identifying some target markets that we want to concentrate on. Frank is involved in both product and strategic competitive analysis and providing marketing materials or delivering on product strategies. So without any further ado, Frank, if you want to take it away.
All right. So yes, good day, everyone. Thanks for the introduction, Neil. And I'm pleased to be here today to have the chance to share with you a presentation I really hope you'll find valuable. We've put quite a bit of time into pulling this information together and making sure that it's something that we hope you'll find valuable. So today we're going to take a look at some comparisons between Sun Life and some of our top competitors, especially as it relates to some of what I would call the more price-sensitive permanent insurance solution options that are on our shelf, those being Sun Universal Life 2 and Sun Permanent Life. So a few years back, as Neil mentioned, I was an advisor myself with daily choices to make about which insurer and which product was best for one situation or another. And something that always mattered a lot to me when I was deciding which company and which product to use for clients was, making sure that the solutions I was providing were backed by strong companies that I felt would be, I was confident that they would be there for the long term, that they were going to be there to have the integrity to stand behind the promises they make. And so I often chose Sun Life. I chose others as well, being an advisor who had choice as you do today. But being number one in the industry today, as you see on the slide, for the last 10 quarters in a row in life insurance sales in total, we really feel proud to be in this position right now. We feel like we've worked hard to get here, and a lot of that, of course, speaks to the strength of our PAR product, which has now been number one for 9 quarters in a row in Canada. So we do feel that that forms a large part of our strength, which is in large part due to the strength of the PAR fund itself. Now, we're not here to talk about PAR today, but I think that strength and that stability that we have both in our PAR block and just in our sales overall really carries through to all the other products on our shelf, and more importantly, our approach that we take every day, putting clients first. Everything that everybody on the teams that I work with in product, pricing, new business, underwriting, even our enforced service teams, the way everyone at Sun Life approaches their work and the attitude that I see every day with my colleagues is truly incredible, and really, speaks to that strength of the company and the brand and the just overall way that people go about their business and their days at Sun Life. Now, as I mentioned a few minutes ago, hold on, sorry. I think I was on to the next slide. Sorry about that. So before we dive into sweet spots themselves for the 2 products we're going to focus on today, I want to quickly take a look at some of our our product business mix and what that looks like compared to the industry. So as you can see in the pie chart on your left-hand side of the screen, most of the industry, actually this is the rest of the industry excluding Sun Life, the PAR versus non-PAR sales for 2022 as a whole were roughly 50-50 with a slight edge towards non-PAR. And that includes, Universal Life, products like our Sun Permanent Life we're going to talk about today, anything that's other than participating whole life, that is life insurance. The industry is roughly 50-50. Now, some of our top competitors fall in line a little bit more with their mix along the same percentages as we do. Some of the top competitors in PAR, I should say. So our mix is more roughly 70. It varies from quarter to quarter, from year to year, but you can say it's roughly 70 to 80% par business and 20 to 30% for non-par business. And this split in sale refers to premium based on LIMRA basis, which is all base premium plus 10% of any excess deposits for products like participating whole life and universal life. And the reason we have such a large portion of our premiums coming from our par business is because those tend to be the products that go hand in hand with the really high net worth market that we focus on quite a bit for our par products. So we get a lot of premium there. But the reality is, as happy as we are with our par products and our sales there, we really want to strive to grow our non-par business more. Even though we are, leading in many of our other product lines other than par, we're always looking to be number one in everything if we can. And today that's why we're talking about non-par today. We're trying to kind of give a little more edge to our non-par products, and we're constantly trying to see what we can do to improve those sales as well. So choosing a permanent life product should be something that comes down to the client need, the flexibility they require from the product, and the client's risk tolerance for volatility. So I think that it really depends on. It's not a one-size-fits-all solution that can be addressed by par in every case, and that really requires some careful analysis, some client education, appropriate recommendations, and for some, par won't be the product that best meets their needs. So it's something that we really choose carefully, and that I think it comes down to making sure that we look at every situation on its own, and making sure that we look at some of the non-par options that we have, and in certain places there's some sweet spots that really fit in better with non-par than par. So let's get right into it and look at some of the non-par options and their sweet spots today. So let's start off with UL. And so sometimes, there are going to be situations where I think, we fit as a UL provider, we fit better than any other provider out there. And that's kind of what we're here to talk about today, is where our sweet spots are. So one thing to keep in mind is that, as we go through these, there's a section here about level COI at the bottom, where, I'll start right off with that section and mention that, the addition of Vitality on Manulife's part added a 10% COI discount in year one to their products. And that's caused them to have, I want to address the bad stuff right away, essentially, and get it out of the way, that Manulife now has the lowest level COI by about 5 to 14%. With a larger difference in males than females. But you know what? That's something that's only guaranteed to happen in year one. And that's something that, as we have done some analysis on their product and what we know of their product, that guarantee goes away after year one. And on a level COI that could last a long time, that is something that 1 year of a 10% discount may not matter a whole lot in the grand scheme of things if that COI discount goes away. So now, excluding Manulife's Vitality discount, I'll stay with the level for now. We are typically really good in the market. Our sweet spot, I would say, is age 50 and over for coverage of 500,000 or more. And excluding that Manulife Vitality discount, we are competitively priced for all males and females, with only BMO having the small price advantage for age 69 and under, while we remain at number one for age 70 and over. So skipping back up to limited pay, so we are number one for nearly all clients, essentially, for male, female, non-smokers, for age 40 and over, at coverage of 500,000 or over when it comes to limited pay. And that's kind of the target range that we really target, is the 500,000 and over. When it comes to UL, we really price ourselves to be more competitive at 500,000 and above. And typically with older ages as well, we tend to focus on, whether it's in some products like limited pay, we're at 40 and over. Others, we're at 50 and over is more of our sweet spot. And then, of course, we have YRT in the middle of the page, where you can see that for ages, when we talk about YRT, a lot of times the default nowadays is a YRT 85 product. It is for us especially, and our ages 55 to 60 are really in their sweet spot in 500,000 or more. And that sweet spot actually grows a little bit bigger when we get up to the 1 million and over mark for YRT 85. We now get to a sweet spot that includes anyone from age 40 to 60 in that bracket, is where we really fit as a leader in pricing there. And for YRT 70, that's a product that really works really well under age 55. And we also have YRT 100, which I don't know if all of you out there are aware of or not, but we don't actually allow YRT 100 to be illustrated on our software. You wouldn't have access to running illustrations yourselves for that. But those are special quotes that our pricing team will run on large cases, as long as the annual premium is at least $25,000 a year. So that is something that's still available, that we have available. We just don't necessarily promote it very much, except, on an occasion like today. I can mention that to you and let you know that that is something that's available on our shelf per se. It's not on our shelf out on our software all the time. We hope to maybe make it so in the future, but for now it's just based on a special quote basis where we offer it for large cases of 25,000 or more. So it might not surprise you to hear that most clients and most advisors are choosing stability over volatility these days when it comes to universal life investments in particular. After all, we have been experiencing volatile times in markets for some time now. And, if stability and quality are topping the list of what people want from an investment option, then you don't really need to look much further than the Sun Life diversified account to get those things. There's simply no investment option out there that provides better quality, better stability for a UL product, in my opinion. In addition to the fact that there's a guarantee that it's never going to credit a rate that's negative, we're currently crediting 3.85% since August 2022. And what makes this product or this investment option special within our UL product is the fact that this SLDA account is managed by the same people that manage our PAR fund. Same approach, very, very similar style of management for a fund than our PAR fund, which we know is a very, very strong PAR fund that is leading the industry right now. So, and then being so similar, one part of this the Sun Life diversified account fund that is very strong and that we're very proud of is the private fixed income portion of it. You can see at 13.1% there as of December 31st of 2021. Sorry that it's a little bit outdated, but we're not quite there in terms of having made it far enough into 2023 to give you a December 31st 2022 number. The percentages wouldn't have fluctuated greatly, but gives you a sense of the approximate amount of private fixed income we have in our asset mix there. And this private fixed income gives us the ability to share and have our clients earn very solid returns on deals that our investment team reviews in-house, with an impeccable track record on having no defaults and adding tremendous value for our clients from that piece of private fixed income there. So let's get right into it and look at some head-to-head comparisons with some of our top UL competitors. So we'll start with Canada Life, and I'll just start by saying that when it comes to YRT structures, Canada Life is not very competitive based on our analysis. So that's why we've chosen here to not necessarily show every COI structure that every competitor has. We're kind of focusing more so on where they are really in the game. So we want to focus with Canada Life a little bit on limited pay and also on level COI. And so as you can see with Canada Life, in the comparison here, when we look at the two right-hand columns in each of these boxes, we can see that everything's in green, which is the green means that we are ahead. If you were seeing red here, which we'll see on some of the next slides, that means that the pricing is better somewhere else. So when it comes to Canada Life, at every age for the scenarios that we've shown here, and we've picked some kind of average scenarios, a few different face amounts that we're showing for comparison. There are some, I'll come out and say that, especially on the limited pay side and maybe at some of the younger ages, as we get up into the at either of the other face amounts at the younger ages, it's very close. We're within 1-2%, something like that. So they're still, right in there, very close in terms of pricing, but we are still ahead at every age that we're showing here. And like I said before, as we get up in the face amount, as we kind of move up market there, and as we kind of go to older ages, that's where we've really tried to price ourselves in a better position, and it really shows against Canada Life here. So Next, we'll look at Manulife, and as I mentioned earlier, it's not as rosy because of the move that Vitality did to UL recently in late 2022. So when we look at the differences on the right-hand side, you can see in the two boxes there for the level COI that everything is red. So they are beating us on price in terms of level COI at those two bands at every age, basically. But what I want to point out here is that difference in many of those years, except for a few in each box, is less than 10%. So what that 10% has done essentially is taken a position where we were a better price, and now they're giving an immediate 10% discount in the very first year. But like I said before, that discount is not guaranteed to stick around. It really depends on the level of engagement that clients have with the Vitality program. So it could be something that's, a bit of a 1 year kind of hype, and then their discount goes away, and now the premium that they could have had for the rest of their life being a level COI would actually end up being better with us. So that's something to consider and keep in mind if you're looking at Manulife and the value that Vitality brings in its first year COI discount. And then we turn our attention to YRT85 comparison with Manulife. This also includes an assumption of a 10% discount on COI. And what we've done here is a solve for 10 payments based on a YRT85 cost of insurance, assuming a rate of return of 3%. And so we're solving for 10 payments in order to have zero cash value, zero fund left by age 85. And we are assuming that 10% discount remains for Manulife every year until age 85. So we're really being pretty generous here. That the assumption is that that person is going to participate in the Vitality program and really engage and get that discount continued over time. And that's something that, even though we're doing that, we're seeing that at most ages we're either very close, or even in the younger ages we are ahead by quite a bit. There is a little bit near the end there in the older ages where Manulife's percentage has increased a little bit, but considering that we are giving them the assumption that they're going to keep having that 10% discount, that's a pretty generous assumption right there to make for us. So let's move on to IA. So looking at how we stack up with them first, maybe in the limited pay UL space, where we're the top two insurers in this space competing for this business today. When it comes to 10 pay and 20 pay COI, which in little different story in 15 pay, I think we're quite dominant in the 15 pay space, but in 10 and 20 pay, where most policies tend to get sold when the limited pay UL space, if we're in the 40 plus and for coverage of 5,000 or more, for 500,000 or more, that's where we really end up having the price advantage. And that's, as I said, that's where we kind of target to have the price advantage. And then IA tends to be in a position where they have an advantage if it's under 40 years old or for coverages that are less than 500,000. And then for level COI, as you can see, lots of green. So we compete really well against IA there, winning on price at all ages in our identified target markets at the 500,000 and $1 million bands. So again, very competitive there. And then our last heads up comparison for UL is going to be BMO. So for the YRT comparison, performed in the same manner as the Manulife one I just explained a few minutes ago, with a 10 pay solve at 3%. We're fairly close at most ages from 40 to 65 in that kind of range, where it drops to in red there at 1.58 from there until we reach 70. At 70, we're looking quite a bit better. We're also looking quite a bit better for minors, but then BMO has the upper hand for adults that are maybe like under 40, somewhere in between the ages of 20 and 40 is where they kind of have their sweet spot. And then the level COI space with BMO, we're fairly competitive on price for insureds who are 50 and older, but for younger clients, they have a bit more of an edge, bit more of a price advantage, especially at lower face amounts. Like the one shown here, but even if we went down market a little bit further, I think they would have a little bit more of an advantage there as well. So as I said, that was our last heads up comparison for UL. We're going to take a look now. I just want to take turn our attention to a couple quick strategies that I want to review that I think would be good to review, so that maybe these are things that you haven't used for a little while with UL perhaps. But first would be, let's look at how UL can help maximize the estate from day one. Now, this may be something that kind of a lot of you already kind of know in the back of your head. You already know this stuff, but I think this comparison really draws some interesting points. This is a comparison from two of our products. So the Sun Universal Life 2 on the left, and the Sun Par Protector 2 on the right, done with a PUA dividend option and no plus premium, just keeping it very simple. And what I've done is I've solved for the initial face amount that somebody could obtain as a 45-year-old female non-smoker if they were going to use $12,000 per year as the premium for their policy. So as you can see, the numbers here are more than double on the limited pay options, on the 20 pay and the 10 pay. You get more than twice the amount with the UL, whereas with life pay you get almost twice as much as well. And this is a client where we would benefit, or we might assume would benefit more in the long run from the growth that could be obtained from a par policy. But with this example, I want to show that even for someone this young, we're giving a lot more guaranteed death benefit up front with UL, resulting in the estate being maximized early on. It's something that some clients might prefer the higher initial guaranteed benefit that something like this would bring to the table, rather than and maybe a 45-year-old would still tend to be skewed towards par, but just wanted to show kind of a bit of an extreme example here where, if you get just 5, 10, 15 years older, the pendulum might start to swing a lot more towards UL. And even though some clients at those ages might still prefer par, I think it becomes just this example is meant to help, show that there could be situations where some clients who really value guarantees, really value, what you have today versus what you might have tomorrow, that some of these clients, I think, the best thing you can do for them is to really educate them on both types of products, or more than two types if you want, but at least giving them a look at what they can have with UL and what they can have with par. For some clients, understanding that difference might actually sway them, they might decide that they want UL more than they want par, which is something that I think a lot of clients aren't involved in the decision making about what product to go with these days. There's a lot of advisors, I think, that are just showing up, knowing that long term the par might work out better for them, but I think there's a lot of clients that, if we gave them the chance to participate in that decision, might actually choose UL. So there's something to be said there for educating clients, making sure that they're part of that decision-making process. So another strategy I just wanted to highlight quickly, where UL can be very useful, is the estate freeze. So here's just a quick recap on how this strategy works and why your clients might want to use it. So an estate freeze is a technique used to freeze the value of someone's business interest, pass the future growth in that business to someone else, but retain control of the business. So the main purpose is to limit the capital gains and the amount that an executor will have to include as an asset for probate tax liabilities as well. And it postpones that tax on the future growth by having it accrue to successors in the business. So as seen on the slide here on the right-hand side, there's two ways to perform an estate freeze. They're very similar. Essentially, what ends up happening is that the new successors for the business have some new common shares without voting rights handed to them, and the original owner now has preferred shares with voting rights. They just go about it a slightly different way, as shown on the slide there. One involves the creation of a holdco that gets involved to do it. I won't go into the nitty-gritty today. You could do an entire presentation on the state freeze strategy. I just wanted to bring back to mind that this is a very efficient strategy to use for clients who are business owners, who will be, passing the business on, but may still want to remain in control for a while limiting the tax implications. And kind of essentially the main crux of this strategy is to limit that future growth and the taxability, kind of freezing that that tax impact today when we know what it is, and maybe those successors are now responsible for the growth and they will benefit from that growth, but the original owner can really limit the extent of the tax today by doing an estate freeze without giving up control of the company. And that's one of the things I want to point out here, is that Universal Life is a perfect product to use for a strategy like this, because it's used to often put in place a fixed amount of coverage of insurance proceeds to address a known tax liability. So that's why it's really ideal for estate freezes. And just want to show, this is our last slide on UL, to show that we have some really great marketing support materials available online. Here I've shown you 3 examples. We have the client guide, of course, which helps clients understand the features and benefits of the product. We have the Sun Life Diversified Account Facts and Figures, which really dives into the asset mix of the Sun Life Diversified Account, and this is a great piece. I really like this one. And the Sun Universal Life 2 Investment Account Options, just a listing of the different investment options available with Sun Universal Life 2, and it does a good job of giving a high-level description of each of those accounts, and some really pertinent information that's available that can be useful when helping clients choose the investment accounts within their UL. So we'll turn our attention to just a couple of slides on underwriting to kind of bridge the gap in a minute. But I thought, Neil, that we would kind of stop for a second and see if there's any questions about UL that we want to maybe address right now, and before we move on into other things, and shortly get into Sun Permanent Life as well. So I'll get back into our little bridging section of our competitive underwriting. So, we know that there's a number of other factors that might be involved in when you make a decision about which insurer and which product to use. Their pricing is important, certainly, but there's other factors that can really play an important role. And I think one of those, having come from being in your shoes in the past, having competitive underwriting, having the ability to say to a client, we're going to be able to apply for this without having to go through blood or vitals, is always a pleasant thing as an advisor. It's a pleasant thing to hear as a client as well. So being able to have really competitive underwriting and underwriting requirements that are competitive is something that we're really happy to be able to provide you and your clients with. And for us, that means for clients age 18 to 40, applying for up to $5 million, that can be done without blood and vitals. And, we call that our accelerated underwriting. And we can do that as well for up to $3 million for ages 41 to 50, and for up to $1 million for 51 to 60. So these are, pretty competitive underwriting requirements. And just to show that, we're not necessarily going to shove everybody else under the bus, that we do have some top competitors that are offering up to $5 million as well. So Canada Life and Manulife both are other insurers that are offering that much coverage in their accelerated underwriting as well. We are the only 3 that offer that much coverage under an accelerated underwriting program. So we are in good company in terms of being able to offer very high amounts with no blood and no vitals. And so let's turn our attention to Sun Permanent Life. So the sweet spots on this product, I think one of the best selling features of this product really is its simplicity. This product keeps things simple. It's a simple permanent life insurance solution, provides a lot of guarantees, and it's very reasonable cost as well. So let me start maybe by the guarantees that this involves. So, guaranteed death benefit, guaranteed cash value, which starts at the beginning of year 3, some guaranteed premiums, guaranteed payment periods, and last but certainly not least, there's also the guaranteed return of premium on death, which is, there's a couple more points on it in the middle of the slide there. So, this unique benefit that we have in the industry means that the guaranteed death benefit will not be the only amount paid to the beneficiary tax-free. Additionally, tax-free, they will get a sum added to that guaranteed death benefit, which is equal to all the premium paid on that policy. So it's a really great selling feature. I think it's a really great conversation feature to be able to say to a client that their beneficiaries are going to get not only the amount of coverage you're purchasing today, but they're going to also get all the premiums that you've put into this policy. They're getting those back as well. So we're going to take a deeper look at this unique benefit in a short while. But first, we're going to have a look at some of those head-to-head competition top competitors in the non-par traditional product space. So let's start with IA, which is going to be the only competitor we're going to see here that we also saw in the UL comparisons. So we're looking here, we're going to see in these comparisons for Sun Permanent Life, we're showing some comparisons at, the 500,000 that you see here. We're going to show some at a little bit lower at the 250,000 band that you see here. And I think we also show some of the million band as well, a little bit. And that's just to kind of show that with Sun Permanent Life, we kind of, our target market expands a little bit. It goes down a little bit lower than it does with UL in terms of face amount. And that's just a nature of the product, and being a simple product that is not as focused necessarily on business owners, a little bit more towards the family market perhaps than UL would be. So, here we see that we have on the left-hand side, the two boxes on the left-hand side with IA is a 10-pay product. And the same would be true if we were to compare our other limited pay durations for Sun Permanent Life. Everything would be green as it is right now with our comparison to IA, and we can see that the numbers are skewed towards being a little bit more favorable in our position later in the ages. So that would be a continuation of the same type of approach that we had with UL, where we're going to continue to see some more positive results, more positive comparisons as we go into the later ages. In this case, actually, we see a little more red as we go into life pay, but not really a lot. And I mean, for the most part, I'd say we are pretty competitive here. We tend to be most competitive or have a bigger advantage as we get into the later ages. And there's a little bit of the rest of it down below age 50 is fairly close. There's a little bit of a, in the 250,000 band, there's a little bit of a 40 to 45 kind of range where IA has, maybe identified as their sweet spot that they want to target, where they're priced pretty well. But yeah, that's kind of how us and IA compare on our Sun Permanent Life product. And then when we look at Desjardins, our next competitor that we're going to look at, when it comes to limited payment periods, we're really pretty closely matched here with very little difference in our pricing. And for the life pay versions, we are pretty closely matched as well. Slight edge to Desjardins for maybe the 40 and under crowd. And while we tend to be better positioned for 50 and over, so kind of split the difference between 40 and 50 a little bit. And then our next one here that we're going to look at is Foresters. And once again, Foresters has a price advantage at younger ages here, which is more significant at lower coverage amounts. As we move up market into higher coverage amounts, a little bit less difference. And things get fairly competitive around 45 to 50, depending on the amount of coverage. And, at the older ages, once again, it tips into our favor. So I think this just reiterates again what I've said a couple of times, that at the older ages and starting around age 40 or 50, depending on the product and the band of coverage, that's kind of where our sweet spots tend to end up being is in those ranges. And finally, our last head-to-head competitor for today for our Sun Permanent Life product is Humania. And I should point out their product, as it says on the slide, is T100. So it's strictly a T100. There's no limited payment periods. There's no cash value in their product. So once again, if we start on the left-hand side here, the lowest band that we're showing here at 250, they do have a pricing advantage in that band that they're very competitive at. But as we move up market into the 500 and 1 million, it's very competitive. We're very competitive with them. There's some ages that we're winning, some ages they're winning. Not a lot. I don't think there's one double-digit kind of win anywhere on those two blocks. And the thing to bring back, to go along with that, though, is that, as I said, there's no cash value in their product. In our products, there would be cash value that's guaranteed with our Sun Permanent Life. So despite that, we're still very competitive on price with them. All right, moving on from the heads up comparisons, let's take a closer look at the potential that the return of premium on death that I mentioned earlier, that what that brings to the solutions that you can use with Sun Permanent Life. So one very smart way to use this return of premium on death benefit is to combine it with a term insurance benefit and with a return of premium on death with a base of Sun Permanent Life. So putting both of those on the Sun Permanent Life really gives clients, the sense that every dollar that they're going to spend is going to be returned to their beneficiary, even dollars that they've spent on a term insurance benefit. So, I don't know that there's anything else in the industry. I know there's nothing else in the industry that's like this, and really that allows premiums that were used towards term insurance to be refunded to the client. And that's whether the insurance ends up being paid out to the beneficiary while the term insurance benefit is still in place, whether that term insurance benefit has just been canceled because maybe they got to renewal and didn't want to renew, or whether that term insurance benefit has expired and is no longer on the policy. All the premiums, any of those situations, all the premiums paid for the term insurance benefit, for the return premium on death, and for the base are all going to be refunded and added to the base death benefit guaranteed. So this is a really unique way to approach this that can really benefit clients, I think, in a very special way. So let me take a look at a scenario here where this is a scenario here for a 40-year-old male non-smoker with an identified need for $750,000 of coverage, which is needed for the rest of his life. So one option for this need is to purchase a simple permanent life product for $750,000 of coverage, shown by the dark blue line on the screen here. However, if we use that method that I just described in the previous slide, where we add a Term 20 rider and the ROPD benefit, what we end up with is a base permanent face amount of $585,000, and we bump it up with a $573,000 Term 20 rider. So we end up at nearly $1.2 million of initial benefit, and we have this boost for the first 20 years of the policy. And then once the Term 20 rider drops off, because of all the premiums that we've paid on the base and on the term rider and on the return of premium benefit, those all add up now to an amount that's still higher than that initial $750,000 we could have gotten with the Sun Permanent Life by itself. So at no point would the death benefit be lower with the strategy of using those two riders added to the base. And we end up with a slightly higher amount in the long term as well. So it's really a win-win. There's no losing here for clients to adopt this strategy, end up having quite a bit of a surplus of death benefit in the first 20 years, and still end up with more long-term and not spend a penny more. So there's really no reason to not suggest a strategy like this to clients. And it gives you a little bit of something if you're considering, comparing products, comparing Sun Permanent Life to other permanent products. It really gives you an edge by doing something like this with this return of premium on death rider combined with a term insurance benefit. Here, another interesting example. So this example here I'm going to show you next is an example that does not include a term insurance benefit. It's just a straight up comparison of doing the base by itself for the Sun Permanent Life, or doing a base plus return of premium on death. And what we've done here to compare it is using the same premium. So you can see both lines, the first two lines of numbers up here on the screen are showing the annual total premium is going to be $100,000. And on that blue line, it's going to be a split of $82,619 for the base that we're going to spend on the base. And we're going to spend about $17,000 and a bit on the return of premium on death benefit. And so what that means is that blue line starts with a base coverage of less than the other policy we're going to compare it to on the orange that has an annual premium of $100,000 that's allocated strictly to the base. So the one that's allocated strictly to the base begins and ends the whole time. It just has a policy death benefit of $5,239,780. The base insurance amount on the blue line ends up being $4.4 million, 4,430,169. But the real important thing here is that because of that return of premium and the fact that we're continuously every year adding more death benefit to what's going to be payable to beneficiaries, we end up with by the time we reach the end of the 20-pay period and we're going to stop paying, and so the death benefit stops growing, we're going to reach an amount that's going to total $6,430,169. So it's your $4,430,169 that we started with, plus 20 years of paying $100,000. So 2 million added into the 4.4 million gives us 6.4. Compared to the 5.2 of the orange line, that's a 22.7% difference that we're giving as an increase in death benefit to the client by having taken this approach, again, without paying anything more. They just have, for the first 10 years or so of the policy, they have a bit of a lower death benefit. From that point forward, it's a higher death benefit having paid the same premiums. So I think this is another really smart way to use the Sun Permanent Life product. There's no downside here for clients. Again, I think it's just a real win-win for clients using this product. And so a couple things I want to draw your attention to as we kind of get closer to the end of the presentation. So here's a feature that you may find valuable that we offer. And we only offer this on Sun Permanent Life within our illustration software. So the quick compare, it's actually what I'm going to start talking about is on the right first, that quick compare on the right-hand side. As you can see near the bottom, it says quick compare, and then anytime you're running a quote for Sun Permanent Life on our software, it's going to automatically bring this up. And actually, I think you might have to click the little box that says show there with the check mark. And so if you click on that, and it will show you the 10 pay, 15 pay, 20 pay, and life pay premium options. So you'll quickly be able to get a sense of how they compare. And as you're preparing an illustration, or if you're sitting there preparing an illustration with a client beside you, you can quickly bring those up and help the client make that decision, or it might help you make the decision if they're not right beside you, to see how those different premium options compare. And then if you're not necessarily having the client with you as you're doing this, you can prepare a report that's separate from the illustration. That's a one-page report there that you see on the left-hand side. Basically, if you just click on print quick compare, this is what it's going to look like. So that button on the bottom of the right-hand side, print quick compare, if you click that, you're going to get what's shown on the left-hand side of our slide here. Really nicely illustrates the different premiums that are being paid, and shows you a timeline of when they're going to become paid up as well, and compares that for all the premium payment duration. So it might be a really nice piece to add to an illustration when you're showing this to a client, to show them, maybe I'm showing you a 10 pay or I'm showing you a life pay, but I think, maybe this client would prefer to do something different, and I want to give them those options and get them more involved. Again, like I said before, get them involved in the decision process of exactly how their policy is going to end up looking. So finally, not finally, we have a couple more slides, I think, but a quick plug here again for some of our great marketing support materials we have available online. Here's a sample of 3 key product pieces that may be of value when talking to clients about Sun Permanent Life. First off, again, on the left, we have the client guide, gives you, helps clients understand the features of this product, how it works. And then the middle piece is one that I really like. It's the top 5 reasons to offer Sun Permanent Life. This can be really useful to make the recommendation for permanent life insurance. And on the second page of this piece, you can actually see all the optional benefits that the clients can choose from to customize their policy. So it's just on the reverse side. Typically, if you're going to print front and back, you still have only one piece of paper there, but it'll be on the back of that page. And then finally, on the right-hand side, we have a piece that's not specific to Sun Permanent Life, but I think it's good to bring into the conversation here, which is a piece that's called Which Sun Life Insurance Product for Which Client. And it really does a good job of highlighting for all of our life insurance products, including term as well. So all our permanent and term life insurance products, what the key features are, what ages are available, what client profiles are, what client needs are that each product addresses, helps you find the right life insurance products for clients. This might be a piece that you just look at that your clients don't end up looking at, but it might be, depending on the client and on whether or not you think it might be useful to show your client and help them understand how different types of life insurance works and what they address, what kinds of needs these different types of insurance address. That's something that you can make that call whether or not to use it with clients, or just keep it to yourself as a reference guide, basically for when each product fits best. And so, as I mentioned at 1 or 2 points in the presentation, I mentioned that there are some aspects other than pricing. We've talked mostly about pricing today, but there are some aspects other than pricing that really can affect, the companies that you decide to do business with. And this will be based on, ease of doing business, on underwriting, like I mentioned, can be based on a lot of things, on the help you get from your wholesaler or from, the in-force service team, anything that enhances your experience, anything that makes your experience a little smoother and work a little bit better and makes it easier to do business with, is something that, can certainly impact your decision of who you're placing business with, in addition to the pricing itself, especially if the pricing is close. So that's, one of the things that when I was an advisor, found myself was of great importance, was new business turnaround times and making sure that things are getting processed in a fairly short amount of time, and feeling like, something's not sitting there for a long time without being looked at. And so I just wanted to share with you the current turnaround times that we have in our new business area. We have an initial underwriting review that is completed within 1 day of the time when it becomes available to be completed. For case management activity, so our new business case managers who look after most of the processing of our new business case activity, their standard is 2 days. I know that on many of our high net worth cases, we actually have that standard that they look to achieve is actually just one day on case management activity. And for underwriting evidence reviews, that's a standard 5 days that we have for that. And that once a policy is ready to settle, our standard for that for turnaround time is 1 day. And I would be remiss if I didn't mention on the right-hand side of the slide our Sun e-app. As you can see, the mention there that the usage is at about 65% of our apps received, and I say about 65 because today might be different than when this slide was first put together, which was still recently, but you never know if how it looks today compared to recently. And but I know that percentage has continuously been ticking up, and it's not surprising to me to see that because I get lots of emails. I'm not intimately involved in the enhancements that we're making to our Sun e-app, but I do get a lot of emails that make me aware that there are new enhancements, and I'm getting those pretty consistently, and I'm sure you're seeing some of that messaging too. And really, that's I think a testament to what our the fundamental approach to when we released our e-app was, we took a lot of time to come out to market with our e-app, but we wanted to make sure that it was really good when it came out. And I think we accomplished that. But I think as a company, as the approach we take with everything, we're always looking to become better. We're always looking to improve on what might already be something great. So we take a lot of feedback about our e-app from advisors. We take a lot of, we don't have an attitude of ours is the best and it's already the best and we can't improve upon it. We really try to remain, open to suggestions, open to feedback from advisors like yourselves to try to improve it. As you're using it, you can come to us with feedback. Let us know if you see something that you think would be better, and if we feel that it's something that we can implement, then we've done a lot of those implementations that we've made have been from feedback from advisors. So we really take a continuous improvement approach with our e-app, and we just are trying to build a better tool all the time for your business. So if you haven't tried it yet, I strongly suggest that you do and check it out. And I believe that is the end of what I want to bring to you today. But with that, I want to thank you for all the business that you do decide to choose to apply for with Sun Life. We know you have options. We really appreciate the opportunity to partner with you to provide solutions for your clients. And Neil, I'll turn it back over to you and see if we have some questions.
Thank you. Thank you very much, Frank. Wonderful presentation. We do have a couple of questions and one comment in the chat. I'll address the comment first. Svetlana is asking who the Sun Life person is to contact. I did look up your contact information, Svetlana, and it would be Yusuden Ran. Yusu in our office would be your number one point of contact from a Sun Life perspective. What I will do for you is I will reach out to Yusu after the presentation and let him know that you're interested in having some contacts. So he'll be in touch promptly on that. From a question perspective, Angel is asking, can you email the documents to us afterwards? Angel, again, what I'll do is I'll have your appropriate regional sales director reach out to you. Frank did an amazing job, tons of information. I think the slides had 3 marketing pieces per product on it. If we were to provide you with copies of all the documents that are available on our advisor site, it would be a truckload, coming through your inbox, so to speak. So I will say one thing, and insurance companies do a great job sometimes of hiding some of the great stuff that they produce, and the respective advisor sites can be difficult to navigate. So I will make note and get the appropriate regional sales director to reach out to you. Regender, how does term insurance premiums are paid back under what conditions? Regender, I'm assuming you are referring to the portion of the return of premium on death that Frank was referring to. In simple terms, unique rider on that particular product. Nobody else in the industry's got it. Every dollar that's put into the plan, both on a base premium and to Frank's comments on a term rider, is returned back in the form of a death benefit. So I hope that answers your question. Before I turn it over to Don, I just want to first thank Frank for a great presentation. Tons of information, lots of competitive positionings. As a recap, I just jotted down a few things that kind of resonated with me, and I hope it did the same with the rest of you that are on the line. UL product, from a UL2 perspective, what does Sun Life offer? Obviously, competitive pricing and cost of insurance options on all of the plans, from a level cost of insurance all the way down to some of our YRT offerings. One of the key takeaways on UL, though, that I can't stress enough is the Sun Life diversified account. As Don knows, I've been doing this for a number of years, and the question that I'm asked on a regular basis is, I've got a client, they want the flexibility, they want the pricing of a UL product. However, they like the offering from a term perspective. Well, with that Sun Life diversified account, your client get the best of both of those worlds. As Frank mentioned, we're currently crediting 3.85%, but you get the UL pricing, you get the UL flexibility, but you've got the access to that private fixed income pool. You've got the ability to smooth, like the SLDA fund is also smoothed over between a 5 and a 7-year period, depending on what portion of the fund you're looking at. So really the best of both worlds. From a Sun Perm perspective, simplified product with multiple different payment options for your client. So if you've got a client that doesn't want the intricacy of a UL or maybe a PAR product, that's a unique product offering. And that return of premium on death feature, nobody else has got it in the industry. I'm quoting every term policy that I quote. I put that return of premium feature on death and a very small Sun Perm portion on it. You can go as low as $200,000 or $25,000 in that base premium. So for a very slight increment in base premiums from just a straight term product, you are offering so much more value to your prospects and to your clients. So if you want to investigate that more, by all means, reach out to myself or your respective sales director, depending on where you're located. The only other thing I would touch on, and from a UL perspective that wasn't in the deck, was price matching. And I have the ability to do, and all of my colleagues have the ability to do a competitive price matching on a UL product. So if you're in a case where it's $25,000 or greater of annualized premium, so moving up into the larger case marketplace where the product is really aimed at, and you find that Sun Life might not be as sharp as one of our competitors that were mentioned on the screen, reach out to your regional sales director and have that conversation with them before you simply just do a life guide quote, because we do have the availability of going back to pricing, going back to actuarial, and seeing if there's room in a particular cell or a particular market for that client. So I just wanted to stress that before we finish the presentation. So those are some of my takeaways. Again, Frank, thank you very much for your time. I know that your days are busy from a product positioning perspective, so we do appreciate you taking this opportunity. And Don, thank you for IDC and the advisors, the 90 plus that were on the line. We know that these are busy days, and we appreciate your time and your attention.